Hi, I'm Michael Yardney, and around this time of the year it's customary for those in the property industry to peer into the future in an attempt to predict what's ahead for our housing markets in the coming year and in fact beyond. Now look, while making such forecasts is not an exact science, I can safely make three predictions that I'm certain are going to come true in 2011. My first prediction is that it will be a bad year for those in the prediction business. Look, most predictions are going to be wrong. My second prediction is that most property investors are going to get it wrong this year. And my third prediction is that those investors who do get it right will do very well out of real estate this year and set themselves up for the years ahead. But before I discuss the reasoning behind these predictions in more detail, first let me explain how I think the property markets are going to perform in 2011 to put it into a bit of perspective. Now, before I discuss the reasoning behind these predictions, I want to remind you that over the coming month, I'm going to be doing a series of seminars with property finance strategist Rob Schaefer and property tax accountant Ken Race, and in some states, Ed Chan. And we're going to be discussing what's going on in our property markets in 2011 in much more detail than I can in this video. And we're going to be telling you how to protect your assets and to set yourself up for the future. Gee, there's lots of mixed messages out there at the moment, so you really need to listen to people who've been there, done that, and I guess whose advice is unbiased. And that's what you're going to get at our upcoming seminars. So click on the link below to find out about when they are, get all the details. You can actually bring a friend for free and join us at these intense one-day seminars. Now, I'm going to explain a bit about the reasoning behind my predictions that I've just made in more detail. But first, let me just briefly explain how I think the property markets are going to perform in 2011, because this could actually put it into some perspective. Look, we already know this is going to be a year of more moderate growth in property values, with property prices even falling slightly in some areas. It's a year when the markets are going to be patchy. Look, some areas are going to perform much better than others, and different states are going to perform differently as they work their way through their property cycle, and within each state, different price brackets are going to perform differently as well. But that's always happened, hasn't it? Now, for instance, I think, though, that the houses at the top end of the market, the more expensive houses, in general those above $1.5 to $2 million or more, are going to perform poorly over the next 12 months. And they're probably only going to pick up when the share market starts to show more positive growth and business confidence returns. This is because these high-end properties tend to be bought by people in the professional or the corporate world. And this demographic tends to upgrade into new homes when business is booming and when the stock market's on a high, and they tend to stay put when the market's flatlining, as it is at present. Likewise, the lower price properties, those generally bought by first home buyers and those in regional areas, I think they're also going to suffer this year. There's a lot of talk about affordability issues for those trying to enter the housing market at present. In fact, Gen Y's looking to make a break from mum and dad or from the landlord, they're going to struggle this year with relatively high prices for our inner city property markets. And that's really where most of them want to go. Increasing interest rates later in the year, as well as rising rents, is going to add to the woes of these Gen Ys and force them to remain on the rental roundabout. Others are going to opt to take a plunge into the housing market, buying into the more affordable apartment market, because for most of them, house prices are going to remain out of reach. But for those who opt to be tenants, the already tight rental market is going to take its toll, with further vacancy rates decreasing. The rates are just going to go down over this year, and in turn it's going to push rents even higher. There's really not much choice in that, is there? Okay, what about interest rates? I believe the Reserve Bank's going to keep interest rates on hold probably till the second half of the year. But as our economy starts to it's easy for me to say, as our economy starts to show signs of strengthening, the central bank's going to be forced to hit borrowers with a number of rate hikes in order to keep a lid on inflation. But not certain, of course, but I think this time next year we can expect the official cash rates to be increased by close to 1% as the economy speeds up. The good news is that we're going to have a continuing large transfer of wealth into Australia from overseas. And this is going to be propelled by China's continuing demand for our natural resources. In fact, I recently read that the Reserve Bank predicts the current China-led resources boom is going to last for about another 25 years, ensuring that our economy prospers over the long term as the transfer of money from other countries into Australian coffers continues. Now this is of course going to translate into stable employment, increased capital expenditure and the need for more infrastructure. And all of this means more spending power for all of us. We're all going to be wealthier. But it's actually not just the stuff that comes out of the ground that the Chinese are going to spend their money on. Demographer Bernard Salt believes that Australia is going to soon become the playground of China's wealthy. And you know what? That actually makes sense to me. Just like the Japanese who holidayed here in droves during their economic boom, the one they experienced in the 80s and the 90s, I think the Chinese are going to do the same as their increased wealth causes them to spend more money, more of their leisure time down under. And this in turn is going to create a tourism boom for Australia and obviously give us all more revenue. In the short term, I think recovery efforts from our terrible string of natural disasters over the past month or so is going to boost in the long term and medium term our economic health, because there's going to be more jobs created, dollars spent rebuilding the affected community. Okay, well, so what does all this mean for you and me, for property investors and our property markets? Well, as I mentioned earlier, in the short term, over the next 12 months or so, we can expect to see prices stagnate or fall slightly as markets still have somewhere further to correct. Look, when you look at median house price data, you can see that on average house prices have been pretty flat since around May last year. And this is likely to continue until later into 2011 if cyclical patterns are anything to go by. Now sure, some prices have actually dropped, some have gone up, but on average it's been much the same. But there won't be a crash, despite all the doom and gloom we hear in the media about our economy and the property markets. Things are not going to fall in a heap. Okay, why am I so confident about this? Well, partly because history is a great teacher, and history tells us that over time, property values go up, and the investors who stay in the game, who can ride the ups and downs in the long term, are always going to do well. Sure, there are periods when property markets are flat and in fact properties fall, but the skeptics who like to warn us away from real estate, they always get it wrong. If you think back over time, the naysayers are out in force when the property markets, the cycle starts to slow down. Look, I've been investing for well over 30 years, well over 35 years, 37 years, and during that time I've been warned about a property crash on so many occasions. Look, just look back only a little short time ago to 2008. We had the global financial crisis, and many suggested property markets in Australia were going to crash. We're all going to lose our jobs, and of course, none of that eventuated. Don't have to go back much further. 2004, the property markets in Melbourne and Sydney in particular, well, the housing market stalled due to high interest rates. You remember, they peaked in 2003. But look what's happened to property values in both those cities since. Go back even further, to the year 2000. There was a heap of negative press and worry about the impact of the GST that was going to be introduced in 2001. People said the new tax would destroy our housing markets and the building industry. Go back even further into the 90s when interest rates peaked and markets stood still for a long time. Everyone said it was going to be the end of the property markets and would be on downhill from then on. And as you look back, it becomes clear that there's a cyclical pattern to our property markets, with the media and clever commentators offering a lot of reasons not to invest. But the truth is, with periods of prosperity and periods of slow or negative growth in our housing market, this has always been the case and it will continue to be the case. Now, remember right at the beginning how I said most predictions will be wrong? Well, this is where the predictions I made at the very start of this commentary become clear. Remember I said first, most of our predictions for 2011 will be wrong. Well, looking at the examples above, it's clear that those who forecast a catastrophic end to the property market, indeed they're going to get it wrong. But more importantly, the short-term predictions many of us make are also wrong, because every year there's an unpredictable X factor. Something that comes out of the blue and takes us by surprise. Well, what's going to be this year's X factor? So far we've had floods and cyclones, but there's probably going to be another. Some unpredictable dynamic that impacts our economy. Could be in a good way, could be in a bad way, but it's going to be unexpected. There's always one, or there's actually more than one every year crops up. Now, my second prediction was that most property investors will get it wrong. Now, that one's simple, because they always do. And I'm not talking about those who don't even have the courage, don't even act, they fail to act to get into the market. According to data from the Australian Housing and Urban Research Institute, 20% of those who invest in housing will sell in the first 12 months. And 50% sell within the first 5 years. They're actually not going to get the long-term wealth creation benefits of that property investing is all about. So on to my third prediction. Those who are going to get it right will do very well. And again, that's always been the case. Investors who see the negative press about property as a counter-cyclical opportunity have consistently done well for themselves. They recognise that the slower market is an opportunity to invest. When others are afraid to buy, and when there are more willing sellers in the market, then there are purchasers. Remember, we're in a buyer's market, but not all investors who buy during this downturn are going to get it right. That's because you definitely can't just buy any property and expect it to outperform in the long term. The key is to buy the right type of property in the right location. At this time in the cycle, you're even going to need to buy below its intrinsic value and a property with what I love to call a twist. Something special about it, like the value add potential that's just going to allow you to manufacture some capital growth through renovations or redevelopment. Ideally, you should look at purchasing an investment in the inner areas of our major capital cities. They've got a strong historic growth pattern of above average capital growth, regardless of the ups and downs of the property cycle. Why? Because the value of property in good locations is going to continue to increase in the future due to scarcity. All of those factors that are underpinning our already healthy economy, the resources and the capital expenditure, the boom, strong employment and the influx of overseas dollars will also have a positive impact on this type of property. The more wealth we realise as a nation, the more prosperous we feel as consumers, and when we feel prosperous, of course, the perception of wealth, the feeling of prosperity increases, and so does our confidence. In turn, we are more willing to buy cars, houses, furniture, electrical items, and yes, houses. So the big question is, what will 2011 bring your way in terms of wealth creation and the property market? Here's one more prediction for you. Most people viewing this market commentary will do nothing different in 2011 than they did in the past. However, if you want to be one of the successful property investors and benefit from the opportunities 2011 will bring, I encourage you to join me, along with finance expert Rolf Schaefer and Ken Race from leading property accounting firm Chan & Naylor, for our upcoming seminars, which I've called Market Update 2011 and Beyond. We're going to give you the outlook that Australian property investors need. These intensive one-day sessions will be held in Melbourne, Sydney, Brisbane and Perth during the months of March and April. And look, I know I'm biased, but you shouldn't miss them if you're seriously interested in creating wealth through residential real estate. Because we sell no properties, we have no properties to sell, so our information is unbiased. It's independent. We're going to give you the strategies you need to take advantage of the current opportunities that abound in our property markets. We're going to debunk many of the myths perpetuated by the media, and we're going to explain what's really going on in Australia's economy and the housing sector. So just click on the links down below to find out all about our seminars, and you can bring a friend for free. Don't miss out. Just click on the link below and reserve your place now. Of course, I'm going to keep you updated with how to take advantage of all the changes happening in our property markets in future updates. But it's probably appropriate to remind you that at changing times like we're experiencing, no one can help you quite like the independent investment strategists at Metropole. And once again, they've won a heap of awards. We got more votes than any other company in Your Investment Property magazine's Readers Awards. And again, we had more winners than any other company. Now, there's so much happening in our property markets nowadays. In between these fortnightly market commentaries, I update my blog almost every day. So just click on the Michael's blog at the top of this page here on our website and subscribe to it. Now that's a different subscription to our regular newsletter. It just gives you short daily updates, and of course you can always unsubscribe. Catch up with you in a couple of weeks with my next update. Please book into the seminars. This is Michael Yardney. Have a great week. Make it a